Hit it.
It's Friday, November 17th, 2023, episode 226. I'm Patrick Ceresna.
And I'm Kevin Muir. This week, we welcome Peter Boockvar, Chief Investment Officer at Bleakley Financial Group and author of the Boock Report. We have a fascinating discussion about how the current environment resembles the .com bubble and the 2008 crisis. And then we talk about the bursting of the sovereign bond bubble and what it might mean for markets. Then it's time for Patrick to pull out the crayons and tell us what's in store in his edition of Talking Charts.
And then we end with no stupid questions.
Only stupid answers? For those who wanted
that was horrible. That was the worst
Patrick,
execution ever.
Wanted me to no, we're not changing. We're not taking it out. Patrick's trying to write in jokes.
This is what happens when you script it.
Yeah.
And then we announced the winners of the dinner with Kevin. We don't script jokes, clearly. And folks, we might even drink some beers along the way. So Lena, help us out here. What beer are we drinking this week? Is it even a beer?
I'm not even sure if this is a beer, actually. We are drinking Suntory Highball.
This is from my trip when I spoke to the nice people at Century and convinced them to sponsor the show.
That's right. So let me read a little bit here.
The interesting thing is it says 9% on the picture, but mine says 7%. So you got me the light version or something here. Or Lena, go.
So it says a canned Kaku Highball, a convenient and crisp combination of whiskey and soda. Our canned Kaku Highball goes well with any meal. Lemon spritz are added to whiskey and soda to enhance the refreshing taste.
Yep, this is definitely not a beer. All right, Kevin.
That's what happens when I'm trying to read Japanese, which I don't. All right. Nothing in this podcast should be viewed as investment advice. Listeners should consult an investment professional before making any decisions regarding topics mentioned in this show. Side effects of too much huddle may include mad macro mumble rumbles, the feckless Fed fumbles, and the acute alpha deficiencies.
Oh, I have all three of those.
All right.
Let's get Peter on the line.
It's our great pleasure to welcome to the show Peter Boockvar. Peter is the Chief Investment Officer at Bleakley Financial Group and author of the Boock Report. Peter, thanks for coming on.
Kevin, I appreciate the invite.
I feel like I've seen you on CNBC over the years so much. I feel like although this is our first time meeting that I know you. I guess you must get that a lot.
Yeah. Sometimes I do, and I have to turn it back to you. I've seen your name and watched videos of you and heard your commentary over the years as well.
All right. So let's get to know you a little bit better. Did you always know you wanted to be in the markets? Like, where did you grow up? How was your background in terms of school and stuff? Like, what was your journey like to this point?
So I grew up on Long Island and was always interested in business of any sort. And in high school, got interested in the stock market, but didn't necessarily know that I wanted to make that as my career. I majored in finance at George Washington University, and but actually went to law school after school because I wanted to be Jerry Maguire before the Jerry Maguire movie came out.
Like you actually wanted to be an agent lawyer?
I wanted to be more of a sports agent. I didn't want to be a lawyer. I felt that the legal background would help make me a better agent. And then the summer after my first year of law school, I actually got an internship on Wall Street.
Okay.
And then actually never went back to law school and stayed out on Wall Street. So I was at DLJ back when
I remember that. Yeah.
Back when there was a DLJ.
Right.
And corporate bond research. And then so 30 years later, here I am.
Okay, so you started DLJ and you're in the corporate bond research. What was that job like? What were your duties? How did they pick you? And why did you give up law school? Like, was it something that just kind of came to you and you said, "This is it. I've found my calling"?
Well, I was just a low level grunt there, learning how to do spreadsheets and models, which was a very helpful foundation. But I just loved being in the markets and learning about a lot of different things. I started out working for the head of research who focused on the utility industry, interestingly enough. So I got a little knowledge on the utility industry. And then did some work for some high yield analysts in retail and finance, and just gave a good background on the analytics on how to look at companies from the balance sheet perspective. And that just enhanced my interest that I developed in high school in the stock market. And then actually stayed on the sell side, but left DLJ after a couple of years and went to an institutional brokerage firm and stayed there for 18 years. And then, but still, managing money for myself and started an advisory business there. And then actually left to work for Lee Cooperman at Omega Advisors on the buy side. And but that was a short, brief stint, just because it wasn't the situation I hoped it to be. Okay. And I left there and went back to the sell side and worked for Larry Lindsey, who was a Federal Reserve governor in the 90s and was George W. Bush's senior economic advisor. When he left the White House, he started a macroeconomic consulting firm. Right. And Larry and I had known each other prior to me starting with him. We became friends. We met at a function. And within a week after leaving Cooperman, Larry offered me a job. And I figured while I wanted to sort of stay on the buy side, working for him was an opportunity that I could not give up. And it was worth every moment working for him. And then, but I wanted to manage money again. And in January 2018, came to Bleakley as their CIO, where I currently run the investment committee. I manage, I'm the portfolio manager on 2 strategies that I created, and also write through the Boock Report on all the macroeconomic and market goings on, basically spitting out my daily missives. So I get to write every day, I get to invest every day, and I combine the macro and the micro, and here I am.
Well, let's just rewind a little. And it was Miller Tabak was the firm you were at for the majority of that time. Is that correct?
Yes. Yeah. I was there on the trading desk there. It was mostly brokerage. I was the equity strategist and did a lot of macro research. And towards the latter end, because I wanted to manage money, we created Miller Tabak Advisors. And so I was actually doing buy-side and sell-side stuff at the same time.
That's wild. Now, so when did you start then? Would that be kind of early 90s, late, like, have I got the timing about right?
Yes, early 90s, exactly.
So you're there as a strategist, and you were previously just like, as you call it, a grunt that was doing some research and work. Like, talk to us about the evolution into like a strategist, and how do you kind of went about learning all those different things. And like, there's a big difference between reading a spreadsheet in terms of going and actually trying to analyze a company versus coming up with some macro themes and stuff. Like, just tell us a little bit like how you made that kind of jump.
Well, I at heart, I'm a stock junkie. And, I started out, and actually I when I first started at Miller Tabak, I actually ran my own hedge fund there for a couple of years, for about 3.5 years. And so I always had, the itch to, and I focused actually on small cap stocks. I loved investigating and researching and buying small cap companies. I felt it was a great way to be a bigger fish in a smaller pond, and getting the opportunity to talk to management and the CEO and the CFO, where bigger company you would not have that exposure.
Okay.
But at the same time, while I was doing that at a brokerage firm where there was a lot of focus on macro, I got an opportunity to learn a lot about the macro as well. I worked pretty closely with my friend Tony Crescenzi, who's currently a PM and strategist at PIMCO.
Oh, I didn't realize that you two were there together.
Yes, we were there together for many years, and I actually just recently saw him at a function, and so we worked together. So I know a lot of people. You're either a macro person or you're a stock person. I tried to marry the two because I felt that to be a better macro person, it was important to very much understand the micro, and doing a lot of work and research and investing in the micro gives you a good picture also on the macro. And I felt it was important to sort of marry the two. So, and Miller Chaybeck was a relatively small firm, so it allowed you to have a lot of different jobs. So I did research, I did macro, I did micro, actually, did trading for clients in terms of execution. So I did a bunch of different things there because of the culture there being very loosey goosey when it came to running a business that was obviously distinct from the bigger firms that is very much more regimented.
For sure.
So having the combination of both of those sort of viewpoints on the big picture and also the smaller picture, and with the background of both in college being a finance major and learning about balance sheets and income statements and taking accounting classes, I felt like merging all of that together just made me a better investor, made me a better analyst, made me just more in tune with the whole picture as opposed to approaching it just from one angle.
And so were you doing all those things during both the long-term capital crisis and also the .com kind of run up and bust?
Yes. So all of that. So when you think about the early 90s, you had Greenspan cutting interest rates to try to save George H.W.'s job, which didn't help. And, coming out of that early 90s recession.
Right.
And then you fast forward to 94 when Greenspan raises the Fed funds rate by, I think, 300 or 350 basis points in a very short period of time and blows up the country of Mexico and Orange County's pension funds.
Right.
Good times. Then you ride the party of the mid to late 90s that was temporarily interrupted by the LTCM, as you mentioned, but also the Asian crisis. But I think seeing that late 90s stock market bubble, which was the most epic thing I think I've ever seen, that culminated in the March 2000 peak. I mean, just in 99 to watch 98, watch these stocks go up $100 in one day and watch the IPO market and the skyrocketing action in these stocks on the day that they went public, and the excitement with Netscape and all these things. I learned firsthand what it's like to experience the bubble.
That's right.
And then to be able to experience the crash. And it certainly was a crash as the NASDAQ fell, or the NASDAQ 100 fell 82% from peak to trough. And then, of course, living through the 1% Fed funds rate that Greenspan gave us that spurred on the housing bubble that then crashed again. And then, obviously, the whole monetary experimentation, we can call it, in response to that crash. And that brings us to today, which is sort of the reversal of that experimentation.
That's right. Do you think that being exposed to those two bubbles and the subsequent crash, sometimes it really influences people, and then they're always looking for a bubble and they're always looking for the crash, and it depends on where they saw the people make the most money. And you'll find people that were around somebody who nailed the Big Short or nailed the .com top. They'll forever be kind of looking to make money on that sell side, on that short side. Do you find that you have any biases that way that you struggle with?
Absolutely. I'm just a cynic when it comes to markets. So maybe I look at the markets as glass half empty, but I think part of that is also a risk management emotional response that I'm always trying to look at where my downside is and hoping that the upside in response to that takes care of itself. There's no doubt that, experience helps in this business. 2021, when you had all the meme stock craze, I just had the memories of the late 90s. Right. And I knew that this was just a repeat of that. And I didn't know the extent at which the markets were going to take it, but I knew this was the same exact mentality. And I knew this was going to end badly as it did after the late 90s. You just don't know when and from what level. But now, for those people that did not watch the markets in the late 90s, it was their first experience. And that's why it got crazy, because most of the people that were driving the craziness weren't around in the craziness in the late 90s and didn't realize that if there's one thing that doesn't change, it's human nature, and human nature just repeats the same things over and over again in the financial markets. That this is the one industry where people don't really learn from history. It's because the new generation doesn't do their work on history, and they think that something new has never been seen before, and it's the greatest thing since sliced bread. Even though the veterans in the market say, "Yeah, it's great," but I've seen something like this before.
Have you ever seen that cartoon? It says something about those who study history are doomed to watch as people repeat the same mistakes of history or something.
No question.
It's a couple old guys sitting in chairs or something. It's pretty funny, actually.
So to that exact thing. So in 2021, when all this craziness was taking place, I remembered, and you would watch this and you would hear like lines like, this meme stock craze. And we're Robinhood's democratizing investing, and the small guy is being able to speak up and all this stuff. I'm like, God, I saw this. I remember the E-Trade commercials in the late 90s.
Yep.
When internet trading didn't begin in 2021, but when you would watch the news and you would see what's going on, they would make you think like this was a new thing, but no, it started more than 20 years earlier. And there was, and I actually posted the YouTube video and one of my notes in 2021 of the commercial where a guy's sitting at his desk at work and he buys a stock. He's not on Wall Street. He's doing whatever. And the stock chart, his stock goes straight up and he feels like he's now made all this money. He leaves his office, walks into his boss's office, quits his job, and then walks back to his office, and the stock had tanked. And then the look of panic on his face that he just quit his job because the stock went up and now it's tanked. So, like I said, these things happen over and again. And the older you get, I think the more things that you see, and it allows you to have a better feel for the type of cycle and mood that you're in.
Right. One of the things that I think I've noticed over the years is that the cycles are the same, but they seem to be speeding up. Would you agree?
I mean, I think they speed up in the sense of the flow of information is much quicker. Therefore, prices adjust at a faster pace. Now, that said, that doesn't mean that things can't get drawn out. But there's no doubt that things respond quicker. I remember reading, one of my early Wall Street reading books was Market Wizards.
Oh, great book.
Where each chapter was an interview with a different legendary money manager, whether it was Bruce Kovner, Caxton, or Jim Rogers, or Soros, and Paul Tudor Jones when he was early on doing what he was doing. And I think it was Paul Tudor Jones, where I think it was back in 1980 maybe, when the Russians invade Afghanistan, and it was like a Sunday, and the news didn't really get out, and I guess he heard about it. And Sunday night, when markets opened overseas and futures started trading, he bought gold before the news went really public. I think on Monday, and he made like $10 an ounce. that was a big deal. But I still think that cycles still play out. The average bear market, even with the flow of information, still plays out similarly in terms of time frame. I mean, look, this bear market that I still think we're in, we're now. I think the bull market peaked in February 2021 in terms of peak euphoria,
right?
And here we are, almost 3 years in. That's a pretty lengthy period of time. So while prices adjust, sometimes it still takes time for cycles to play out. Again, because human nature is human nature, and cycles are cycles. And I mean, you can argue that this economic cycle is going to take a lot of time to play out, even though we see what's going on because of the big rise in the cost of money, and how that takes time to flow into the broader economy in terms of its impact on people that have debt and need to borrow money.
One of the things is a lot of times history kind of repeats, so it doesn't quite repeat, it rhymes. And we can sit here and we can say that it's very much like the .com, and I completely agree with you there. But in some ways, it's also a little bit different in that I don't know about you, but I would have never guessed in a million years that the Mag 7 would have rallied as hard as it did after that February 2021, topping formation, and we went lower. I completely thought as well, just like you said, that was the end of the bull market. And yes, we might have a rally, but here we are. And the Mag 7's dragged it up higher. This feels very much like the Nifty 50, which neither one of us are old enough to remember. But I was wondering if you have any thoughts about that and about this kind of unique environment, at least in terms of unique, and that most people don't remember the Nifty 50 that were around then. This unique environment where the Mag 7 is just so much a part of the indexes that it kind of distorts what's happening beneath the surface.
Well, that's certainly the case, because the other, I like to refer to them as the cult 7, because there is a cultish attitude towards these names. It's people somehow think that these 7 names breathe different economic air than the rest of the market.
That's a great line. I like that.
But when you think about, you take Apple, for example, well, they're reliant on the spending habits of the consumer. Meta and Google are reliant on the advertising spending habits of a lot of small and medium-sized businesses. So not only are the customers of Meta and Google the other 493 stocks, but also the 2000 in the Russell and all these other stocks that advertise on their platforms. But they somehow get treated. Now they're great business models and phenomenal balance sheets. So I understand the attractiveness of them, but they're still not immune to broader macro trends. And we certainly got a taste of that this year, and even early part of the year before the AI craze came about. The growth rates of these companies have been slowing a lot to rather, pedestrian levels. But because of the cult status, they're put on. They've become their own asset class. So you have bonds, you have stocks, and you have the cult 7 that are somehow again breathing different economic air. But I think when this bear market's all said and done, now those stocks have certainly corrected, but they bounced hard as AI gave them sort of a second wind.
Right.
But the bear market won't be over until there's a re-rate in those names, and instead of the S&P 500, which is obviously hugely influenced by them, is trading at 18 to 20 times earnings. We'll get back to a more of a historical norm of 13 times forward, 15 times trailing. That will happen. I'm convinced, particularly in this higher interest rate environment. But we're already seeing evidence. I mean, Apple's growth has slowed. Now, I'm not talking down these stocks like I'm going to be short them. We're long them for clients, just as it's almost like it's like you have no choice just by peer pressure.
Right.
You have to own them. But there's no doubt that businesses have slowed a lot for a lot of these names, and they're just not the same growth drivers that they've been. And just as history always repeats, after a 10 to 15 year run of outperformance, there's always a 10 to 15 year of sort of give back in those names relative to others. And I think we're on the cusp of that sort of mean reversion.
I actually saw a period where it almost felt like you talk about them being a different asset class. I think that's a great way of describing them, because there was a point when it felt like they were actually like a safety trade. Like you get investors would get nervous about the economy and they'd run to the Mag 7 or the Cult 7, as you call them.
So using my year 2000 as experience, it was the same mentality. So in March 2000, that was the peak in the NASDAQ, and they started to take out names one by one. I actually think it started with MicroStrategy in March 2000 was the high flying name that got taken out and shot. And as the year progressed, they took out more and more companies. But what these investors did was they started to hide out in Intel, in Cisco, in Sun Micro, in Oracle, in Microsoft, thinking that somehow those stocks were safe. without connecting the dots that, well, who is Sun Micro's customers? They were all the companies that were blowing up, all the IPO'd companies that were buying servers and buying software and buying, and PCs for their offices that had Intel chips inside. So they weren't. So I remember just the commentary mid 2000. Oh, it's no big deal. The Fed's raising rates because the balance sheets of Cisco and Intel are so good that they're fine. And I'm thinking, well, all their customers are blowing up. Don't you get that? Right. But the S&P 500 in March 2000 retested its March in September 2000 retested the March 2000 high. I think because it was led by these few names. And I think we're seeing the same thing now, where people are hiding in these names, saying, "Oh, their balance sheets are great. Who cares about rising interest rates?" And I'm like, no. That's not the way you're supposed to analyze these companies with respect to their earnings. You're supposed to be looking at how their customers are doing, because that's what drives the earnings of these cult seven. And but I think we're beginning to realize that. I mean, Apple's growth rates, even though the stock has bounced mightily after numbers and the initial hit, their business is not growing anymore. And take even Microsoft, they have single digit growth rates now, high single digits, but phenomenal company in business, and they're well positioned, but growth is just slowing. And all these businesses do business internationally, and we know that the economy globally is very challenged. So I think just relying on the playbook that has worked so well over the past 15 years is just it's getting a second wind, as I said earlier, but I don't think that that's a sustainable trend.
One of the things you mentioned there is the kind of increasing competition that bonds are going to pose towards the stock market. And I was wondering what you think about the fact that the equity risk premium has recently kind of dipped to the lowest it's been in 2 decades. And I just give this example that in 2020, March of 2020, the 30-year bond was 1.5 or something like that. And the NASDAQ had I guess it was a forward earnings yield of 5.5 or 5.75, and that was on depressed earnings. And today you kind of go and you look at it in the 30 years, 4.75 or whatever it is, and the NASDAQ is a 12-month forward earnings yield is something like 4.25 or 4.5. And not only that, that's based upon earnings that have been growing forever. Do you think that that's going to be something that when we look at pension funds and other endowments, long-term money that kind of that will be shifting out of equities into bonds? And how quickly, if you do think that that's the case, how quickly do you think that'll occur?
Well, there's always rotations that go on, because you have to think about, if for that pension fund that sells stocks to buy bonds, well, someone is buying their stocks from them and someone is selling their bonds to them. It's really it's the urgency of that happening that makes stocks move up and down. And I think when you look at a bull market, yes, stock prices follow earnings in terms of trajectory, but a big contributor to a bull market is multiple expansion, and a big contributor to a bear market is multiple contraction, as we know. And I think that the market, many people in the market have re-rated small cap stocks, for example, and other parts of the market outside of these cult seven, and even some names below that. And there has been a re-rating that has begun in a bunch of different parts of the market. But I still think that there's a lot of that re-rating to go because of this much higher cost of capital world that we're in. So not only do you have a multiple re-rating that still, in my opinion, has time and space to play out, but you also have the economic impact of this very sharp rise in the cost of capital. I mean, when you, and I'm going to tie this back into our previous experiences. When you look at, we had the tech excess and then we had the housing excess, and people say to me, well, what's the excess now? I don't really see it. I say, my response is, well, we had the greatest financial bubble in the history of bubbles in sovereign bonds over the past 15 years. That peaked when we had $18 trillion of negative yielding securities. And that unwind obviously really picked up, really began in the early 2022, late 2021, and has a ways to go. And as part of that unwind, you're going to have, as I said, the multiple compression, but the economic impact is going to take time, but be rather stark. And so there's a long way to go here.
Okay, so we have two things that you're talking about there. One is the change in the multiple, and the other is actually the economic effect of the raising of rates. So why don't we start with the economic effect? Do you have any theories of why the market is being so surprised that it's taken so long for any economic effect of the rate hikes to show up?
Well, the effect is happening every single day, but it's not necessarily making its way onto the front page of the Wall Street Journal. It did with Silicon Valley Bank and First Republic and Signature.
Okay.
That sort of was, it really started in 2021 when the meme stock craze ended and blew up. And then you got to March 2022 and you had the banks that started to blow up. But like I said, every day somebody's loan is coming due. That was priced at 3%. That is being repriced today at 9%. So the way of that I've referred to the economic response is death by 1,000 cuts. And I think we're seeing that. And that has happened in Europe. It's happened in the UK. It's happening in China. It's happening even in the US. Putting aside the 4.9% Q3 GDP number, I would not be surprised if Q4 saw a minus sign or a zero sign in front of it.
Oh, you think it's that quick? Like you think we're going to slow down that fast?
I mean, I listen to a lot of conference calls just with stocks that we own, stocks we don't own, as I want to hear what companies on the ground have to say. And all you have to do is listen to what Walmart and Target talked about. And it's not hard to connect a dot to very little growth in the economy, especially since the consumer is the main driver of it. And you have some spending on the value side and the necessity side, but to me, I don't see the economy growing much. If you just listen to what these retailers had to say this week, and especially hearing what a lot of other companies have said. I mean, I know I'm going off on a tangent here with the economy.
No, go for it.
U.S. manufacturing, global manufacturing's in a recession. There's no debating that. If you look at the pace of existing home sales in terms of transactions, that's in a recession. The purchase component of the weekly Mortgage Bankers Association data is near the lowest level since 1995. We bounced a little bit this past week. That's in a recession. The lower income consumer is in a recession. So there's a lot of challenging aspects to the economy. And like I said, as more and more companies and more households get caught up in this higher cost of capital world, more and more money is going to be allocated to interest expense and less so on growth. Less companies are going to get funded because of the cost of capital. I mean, when you think about when the cost of capital is low, it's very easy to fund 10 companies. Now, maybe 3 of those 10 are getting funded right now. So it takes time for this to work out. It was easy to sort of, pin or prick the tech bubble. It was easy to prick the housing bubble. This bubble is going to be more pronounced, but more prolonged in how it plays out. And okay. I think what you're seeing in the market is that people are just taking out their old playbook at, the Fed is done hiking, everything's going to be fine. I need to own stocks. Because worse comes to worse, the economy slows. Well, the Fed has all these rate cuts that they can use. And everything's going to be fine, and that the Fed is going to make things fine. And those people are forgetting their history too, where the tech bubble or the tech bear market happened as the Fed was cutting interest rates. The housing bubble bear market occurred as the Fed was cutting interest rates. In fact, the stock market, the S&P 500 made its peak in October 2007, just as the Fed was cutting interest rates, because everyone thought the Fed's going to save us. So that's why the market is trading at 4,500, is on the belief that the Fed is going to save us and inflation is moderating and everything's going to be fine. But I just don't think that this plays out so easily.
And do you also think that the market might be making a mistake in assuming that the Fed will cut rates as quickly as they expect?
Yes, I do. I do think that the Fed will blink and cut rates, but I think that their ability to do so without unintended consequences and trade-offs, I don't think they're going to be able to get away with much. And even while they're done hiking here, there's still a lot of balance sheet shrinkage to take place. I mean, it's amazing how everyone has got so excited over the last 15 years of a QE, and QT is just not a big deal to them.
I know. It's fascinating.
Yeah, QT is a really big deal, and QT is global, and that a lot of central banks are doing it. And I just think that there's this incredible nonchalance with thinking that by the Fed not raising the Fed funds rate anymore, that somehow monetary tightening is over. Not only do we have QT, but just by keeping rates high for a while is a continued form of monetary tightening.
For sure, yeah.
Especially for that real estate guy whose debt's coming due in February 2024. Fed doesn't need to hike anymore, and that person's going to get hurt next year.
The thing of going to, just quickly on QE and QT, it always kind of fascinated me that the Federal Reserve was willing to use QE as a policy tool, meaning that they increased QE when they needed to stimulate the economy. But on the other side, when they wanted to slow the economy, they're like, no, we can't possibly use QT. We're just going to put it, we're going to use it, just put it on autopilot. And I've thought it was a huge mistake to, when they were cranking rates at 75 bips a clip, what if instead of doing 75 bips, they were doing 50s or 25s, but they were selling $100, $200 billion a long end, paper? I think that the curve would have been steeper. It would have changed a lot of things. We might not need to be as high. There's a kind of, I think it was been a huge policy error on the Fed to not use QT more aggressively. Do you agree?
That's a great point. I don't know actually. And the only reason why I say I don't know is because they've only done QT once before. This is all so brand new, and it's hard. When you look at QE1 and QE2, the purpose of them was to suppress long-term interest rates, but long-term interest rates went up during QE1 and QE2 because people bet on the reflation trade. So the rates actually did the opposite of what the Fed intended them to do. So while in theory it sounds right that that's what the point you made is what the Fed should have done, it's only sort of in retrospect would we have known. I think that the Fed is winging it basically. Yeah. And all central banks, they were winging it in terms of easing, and they're winging it now in terms of tightening. And one of the things that at not the last press conference, but the one before with Powell, a reporter basically asked, when do you stop QT? And Powell's answer was, we'll know it when we see it.
It's like the judge that said about pornography.
Exactly.
Yeah.
And so they're all experimenting.
For sure. It's going to take a financial accident for them to stop. Right.
And that will be the case. And it'll be the S&P 500 at 3,000 or 2,500, that gets them to panic. And but that's what usually happens is, policy gets to a certain point that creates such a pain point that that's what gets them to respond. But it was always going to be higher inflation. That was going to be the kryptonite to their experimentation. And it was the lack of inflation that allowed them to experiment to the extent that they did. Not only low inflation, but they experimented because they wanted inflation.
Right.
I would love to interview Mario Draghi today and say, Mario, was that really a good idea what you did?
Oh, well, the whole negative rates is another story for another day. Okay, so we talked about the economic side of the stock market and the economy. And the other thing that you mentioned back then was you said that there's going to be a re-rating in terms of the PE. And you mentioned that you thought it was going to be trading at 13 times forward and 15 times trailing is kind of your target. Where do those come from? And why don't you explain to people why you think we're headed to those levels?
Well, that's just based on history. That's just what we've seen over the last 100 years on average. Now, the last 15, 20 years, that was certainly not the average because of, QE and negative and zero interest rates. So all I'm basically saying is we could have some mean reversion here with respect to the ultimate multiples. Now, we can get bailed out with that in terms of markets if earnings go up a lot. That you can have 15 times a higher earnings level. But on the flip side, if you don't have higher earnings, then a lower multiple leads to a lower market. So now a lot of small cap stocks, mid cap stocks, they've gotten destroyed. They've gone through maybe their own bear market already.
Right.
But bull markets don't affect everybody all at once. Bear markets don't affect everyone all at once. I mean, many stocks peaked in February 2021. But the S&P 500 didn't peak until early 2022.
One of the smartest hedgies that I know, he's been saying to me for a little while now, he says a lot of these small caps or the cyclical names, they're almost priced for recession already.
Oh yeah, there's no doubt that they have been priced for recession. There's no doubt. But you look at 2000. I mentioned earlier the Nasdaq peaked in most stocks peaked in March 2020, but the S&P 500 got back to its high in September 2020 or just below it. When you think about the mid 2000s, a lot of stocks peaked in like late 06. The S&P didn't peak until October of 07. And even when things bottomed, a lot of stocks bottomed in September of 08 when Lehman blew up, but the S&P didn't bottom until March of 09. So not everything works together. And so you can have certain stocks that if their bear markets are over, but other names like the big caps, that their bear market is not over.
Do you worry about a repeat of the quant crisis of 2007? That a lot of people that are outside the industry probably didn't even realize that there was a quant crisis. But it seems to me that with this increased amount of factor investing and all these, these pods that have all these different kinds of, factor trades going on and stuff like that, that the chances of something occurring within the market that really causes dislocation is higher than it's ever been.
Yeah, that's always a possibility. Yeah, that's always out there. And typically a high cost of capital typically triggers a reversal in a lot of these crowded trades. But always trying to figure out when that happens is always very difficult. I think that the biggest thing that I think has impacted markets here since late July is this rise in long-term interest rates. We're certainly getting a respite here over the past couple of weeks, certainly with the benign CPI number and the moderation we've seen. But that's the biggest, I think, variable that is going to dictate markets here. Because, again, to my point earlier about everyone believes that the Fed is somehow in control here and make things better. If long-term interest rates, after this recent pullback, resume their upward trend for a variety of reasons, that's going to be a big problem for markets. Because if you get into a situation where the economy is slowing, but long-term rates go up, well, maybe the Fed cuts short-term rates, but maybe the long-term rates go up even more. And then you start to think about where the dollar goes. And there are a lot of different scenarios on how things play out from here. And it's not so easy as inflation's peaked. economy's slowing, the Fed can cut rates in response, and everything's going to be fine.
So do you worry about the long end of the bond market? And do you think that we could have kind of a gilt type crisis here?
So that gets to my point of we're unwinding the biggest bubble in the history of bubbles. And it doesn't just unwind in a couple of years. Now, that said, long-term, anybody who has been long a 30-year treasury going into 2022, they've lost half their money on a mark-to-market basis. If they want to hold it for another 28 years, they'll get their principal back. But that bear market in long-term bonds has been as brutal as previous stock bear markets. So I don't want to make it seem like there hasn't been pain that has been felt. But interest rates tend to move in very long-term cycles. We came off a 40-year bull market in bonds that followed a 25-year bear market in bonds. So these things run in long cycles, and so this one doesn't just end in a couple of years. So I do think that long-term interest rates continue to head higher. And to your point about sort of a UK replay, I can't discount that as being a possibility. We're going to wake up one day and the Bank of Japan will be out of negative interest rates and they'll get rid of yield curve control. And I think that the move in the U.S. 10-year from 3 3/4 to 5 was triggered by the Bank of Japan widening yield curve control from 50 basis points to 100.
Oh, you do? Like you think that was the driving factor on that?
100%. You look at so I think it was July 28th that the Bank of Japan made that move. But a few days before, it was leaked in the press that they were possibly going to do it. You look at a chart, and it was within days that the 10-year yield, not just in the U.S. but everywhere, took off. So I know people we want to blame excessive Treasury issuance because of the rising U.S. debts and deficits. No doubt that's a factor. But the move, like I said, from 3 3/4 to 5, to me was triggered by what the BOJ did, because they were the last major central bank to finally get around to tightening. And they were essentially the author of modern day monetary policy. I mean, Bernanke took his cue from the BOJ in terms of zero rates and QE. So to have the Bank of Japan finally moving, that is what led to this global rise in interest rates. We're getting some pullback here, but what the BOJ does has a tremendous impact on where European and U.S. bond yields go.
So if you look at Bank of Japan and you kind of step back and think about where their inflation is right now and what their fair value of their 10-year treasury or JGB should really be, you could make the case that we should be a lot higher, and that in terms of yield, and that this is just the start. And if that was the case, is that potentially what you see as kind of the black swan that nobody sees coming, is kind of an unwind of the Japanese easing?
Yes, and again, it's the unwind of the sovereign bond bubble everywhere. I mean, if the 10-year JGB yield, which is now backed off to I think 75 basis points, if it busts through 1% to the upside and goes to 1.25%, 1.5%, after the BOJ gets out of negative interest rates because inflation is still running twice their target, the U.S. 10-year is not going to still be at 4.40. It's going to be at 5.5. The German Bund yield is going to be higher. The 10-year gilt yield in the UK is going to be higher if these central banks start to lose further control of the long end. So that is a big possibility.
And when I'm thinking that through, I'm thinking, okay, so that happens. All of a sudden, the stock markets go down. It causes the economies to slow, so everybody eases. But then what happens if everybody eases, and that causes more inflation, which scares long bond investors even more?
Yeah, exactly. So let's take this also another angle. In the middle of next summer, or even the end of Q1, U.S. economy rolls into recession. Powell starts to cut, and the dollar tanks, and oil goes to $120. He may be cutting short-term interest rates, but if that happens, I argue the 10-year yield's going much higher. There are a lot more potential trade-offs with respect to monetary policy this time around, Whereas prior cycles, there weren't many trade-offs because inflation was always low. The Fed can hike, they can slow things down, but they blew up the tech bubble, they blew up the housing bubble. But when they were able to cut, they were able to sort of create a shock absorber to the economy because inflation was low. This time around, it's a much more dangerous game.
Okay, so if that's the case, and in the past, like a lot of the most famous hedge funds in the world, they made all their money investing in like buying the front end of the curve. That might not save you as much as you would hope in a kind of a market crisis event.
Well, buying the front end, you'll be okay if the Fed starts to cut. It's those that take on too much duration and buy the long end that could get really hurt. I think there's so many people that want to own the long end because they're looking at decelerating inflation and slowing economic growth.
Right.
And I get it. If those were the only two factors driving long-term interest rates right now, I know historically it is, but right now I would say, yeah, collect this yield while you can. I'm just afraid that we've seen a rise in long-term interest rates for not good reason. And that is the unwind, as I talked about, of monetary policy around the world. Yes, it has to do with rising U.S. debts and deficits. That's definitely a factor. And if that's the case, where excessive supply matters here, in addition to again this monetary unwind. Well, let's just say you go into recession. Well, what does that mean for the U.S. budget deficit?
Yeah.
I mean, here we are with a budget deficit as a percent of GDP through the fiscal year ended September at 6%. You go into recession, that'll be in double digits. Tax receipts falter, government spends more money to cushion the recession. And then you get instead of $2 trillion budget deficits, you get $3 trillion budget deficits. And can the market absorb that? At the same time, the Fed's not doing QE, which maybe they'll have to turn on QE. Foreigners now own 30% of the U.S. Treasury market, down from 40 10 years ago and down from 50 at its peak. And banks, well, they don't want to take on duration. So you can get a disorderly rise in long-term interest rates in a recession as the Fed is cutting. And then if like I said, if oil starts to spike because the dollar tanks, then you got an inflation problem all over again. Now, I want to emphasize that I'm not saying that all these things happen. All I'm saying is that it's very possible that these things do happen and that you can't just buy the U.S. 10-year yield or 10-year treasury and betting on lower rates only because of inflation and growth, because there are a lot of these other dynamics at work. And I think we're seeing that. I mean, just over the past couple of weeks, we're seeing a slowdown in the jobs market. We're seeing a deceleration in inflation, but the 10-year yield is around 4.5. And while that's down from 5, that's up from 3 3/4 at the end of July. So the end of July, we've seen inflation, core inflation, go from 4.7 down to 4. And we're seeing a cracking in the U.S. labor market, but the U.S. 10-year yield is up 75 basis points from where you were at the end of July. That's telling me that there's other stuff going on, and the factors that I've mentioned.
So, what do you do to protect yourself? You can't buy the long end. I guess you can hide at the front end, but
you hide at the front.
Is that all there is? Anything else that you can?
What we've seen over the past 2 years, what's the safety trade been? It's been energy stocks and gold. Now, energy stocks have recently gotten hit with crude backing off to in the 70s, but many of them have been safety trades. Precious metals have been safety trades. Even overseas markets have been safety trades. Japan has been a safety trade.
Yeah.
Luckily, we've been long it. So there have been some parts of the market that have been safety trades. Now, of course, this year you can say the Cult 7 have been, considering the rally that they've had. But there are opportunities out there, as I mentioned. Those uranium has been a safety trade, which we think that will continue to be. So there are parts of the markets that you can sort of hide out in these different scenarios. I just think that you need to look at things that haven't worked over the last 15 years, the things that have already gotten beaten up, instead of, again, just hiding in the cult stocks, thinking that that's going to save you.
Got it. Well, so that's some fascinating stuff. So, Peter, we're going to end with our questions. Let's start with the first one. What do you think is the hardest thing to do in trading or investing?
Admitting that you're wrong.
And have you gotten any better at it over the years?
Only slightly. No, it's you know, this is a humble business. Humility is an important characteristic to have. And being able to look in the mirror and saying, you know what, I screwed up, I was wrong, I need to take this loss and move on. I definitely have gotten better at that. There's no doubt that sometimes I get too stubborn. That still is a characteristic. But I've definitely gotten better at admitting my mistakes.
Well, you know, one of the things I always say that keeps me humble is that Stanley Druckenmiller, who I consider one of the greatest, if not the greatest investor of all time, said that his hit ratio is 60%. So that means he got 40% wrong. And I'm no Stanley Druckenmiller, so I know I'm going to be wrong a lot. And I always try to remember that.
That's an important thing from Stan. And one of the things that I admire so much about him is, and interestingly, I hung out with him a few times when I worked with Larry Lindsay because they actually went to college together, interestingly enough.
Okay.
And I think Stan was Larry's first client when he started his company, is Stan's ability to be flexible and be humble and to be able to acknowledge when he's wrong and basically keep an open mind. I think that was one of his impressive skill sets.
Yeah, he's just he is the GOAT. Okay, number 2 is Don Cox used to say that you shouldn't invest on what is on page 1 today, but it's what is on page 16 on the way to page 1 tomorrow. Do you have any trades that you feel would get the Don Cox seal of approval?
So I was on a panel a few weeks ago in New Orleans at a conference, and the question to the panel was, each of you give your contrarian trade for the following 12 months. And I'll give mine as an answer to this question.
Okay.
The Hang Seng will outperform the S&P 500 over the next 12 months.
Oh, I like it. That is a Don Cox special. I love it. Do you have any reasons apart from the fact that everyone loves the S&P and everyone hates the Hang Seng?
I think that the Chinese economy will definitely challenged with its manufacturing sector, but the world's manufacturing sector is challenged, but the Chinese manufacturing sector will be the first to rebound once the world starts buying stuff again, which they will. I think the property stress is well into its stress, and it's a good thing to see a lot of these developers go bankrupt because it cleanses the decks. And I think the Chinese, people forget that the Chinese consumer, the Chinese middle class, the middle class in all of Asia is one of the most exciting growth stories over the next 10 to 20 years. And the Chinese consumer wants to live life like we do. They want to go out for dinner. They want to travel. They want to spend. And I do think when they regain some confidence, which they will, that will be a benefit to not only the Chinese economy, but to the entire Asian region. And a lot of companies that trade on the Hang Seng will benefit from economic growth in the region of Asia, which happens to hold about half the world's population.
That is a terrific. I really like that call. That's bold. It's Don Cox would be really proud. I said 3 questions. Actually, I got to sneak in a 4th here because we have this other feature where we get someone to ask a question from last week and pass it on to the next guest. And you're lucky enough to get Andy Constan's question. So here we go. Here's his question.
I got a good one. So my friend Victor Hagani, who is was at Solomon with me and then worked at Long-Term Capital in a senior position, partner. And then since then has really focused his entire life on beta. Just wrote a book called, what was it called? Missing Billionaires. Anyway, Victor asked me a question about 2 years ago. And he said, if I offered you a certain real interest rate for life, how high would it have to be for you to no longer try to outperform the market?
So I thought this was a great question because in essence, it's like a tip, like it's a perpetual tip, meaning like how much above inflation would you have to get to stop trying to beat the market?
So let's say that the long-term earnings growth run rate matches nominal GDP. So let's just say we have 2% inflation, like the Fed wants it to be again, and you have nominal growth at, call it 4 to 5, so you get potential earnings growth of 7%, which is a long-term average, and then the 7 on top of the 2% inflation, or maybe even 3%. So I would say a 5% real rate would be a magic number.
That's where you're tapping out.
Yeah, that's where I would tap out.
Yeah. It was funny because Andy kind of, I asked him offline because he asked the question. I said, what was your number? And he says, well, my number was, he was much lower. And he says, the problem is that with 30-year tips up here, because 30-year tips have gone from -1 to like 2.5, almost 3%. We're actually almost close to my number.
Well,
and I have no desire to tap out, he said.
Yeah, I mean, don't get me wrong. A real rate that we see in tips at 2.25, they were 2.5 just recently, is very attractive.
Right.
But it's so attractive just because it's compared to the unattractiveness of where it was for the prior 15 years.
Yeah, no, you're absolutely right.
I would take 2.5. That's when you start legging in.
I got it. That's where you start. Okay. Do you have a question for our next guest that you're going to pass along?
Yes. So this is not necessarily a market-related question, but I think for all of us in this business, if you want to be really good at it, it's all consuming in a way, right? It's 24/7. It's even when you're out of the office, a lot of times you're thinking about the markets. And to the next guest, are you thinking about the markets when you're not in the office? Are your weekends consumed when it's not with family stuff? Are you reading the papers? Are you reading the stack of research that you brought home on Friday afternoon? Are you always thinking about the markets?
I like it. And unfortunately, I think too many people are going to answer yes. And that's actually encroaching on my family time. I think a lot of us struggle with that.
Yeah, it's tough. I mean,
I know I do.
I know. I remember the day when the Wall Street Journal announced we're going to start a weekend edition. I'm like, oh, now there's another thing that I have to go through.
It's not just Barron's. It's now the Wall Street Journal. It's the weekend.
Yeah, it's Barron's. It's not just the Financial Times. Now I got to read the weekend section of the Wall Street Journal. Okay. So half your, all of your Saturday is just getting through the papers, let alone all the other stuff that you didn't get around to read during that previous week.
All right. So I'm going to end with the final question, and I'm going to steal this from Ted Seides from Capital Allocators. And he often asks his guests, what was the kindest thing someone has done for you to help you along with your career?
So I think it was the woman who helped me get my job at DLJ, who really didn't know me from a hole in the wall, that was a friend of a family friend, and sort of put me under her wing. She was a sales trader on the bond desk at DLJ, and just selling investment grade corporate bonds, but sort of took me under her wing in terms of meeting people and looking out for me. And that's something that I won't forget.
Do you want to share her name, or you want to keep that private?
Dana Brett Levy.
Okay. Well, Dana,
I haven't spoken to her in years, but I hope she's well.
Oh, that's great. All right, Peter, it's been a blast chatting with you. For people who want to learn more about the different parts of your business, let's just start with you mentioned Bleakley Financial. What is that and how does it work?
So the wealth management firm that I'm the CIO of is your traditional wealth management firm. We have about 50 to 55 different advisors, many in New Jersey, but 18 other cities. Again, a conventional wealth management, and they can go to Bleakley.com to learn about that and the things that we offer. And I'm the portfolio manager of 2 strategies here. And then all my daily thoughts and missives I put into the Boock Report, which is on Substack now, peterboockvar.substack.com. And I just daily write about all the macro, economic, and market stuff that I find relevant, and I try to be respectful of people's time and do it in a concise and succinct way.
And you do a great job of doing that and getting down to explaining what a lot of the different kind of economic indicators, what they're saying, what you're looking for. I'm just shocked at how quickly you fire it out and stuff like that. And you were just mentioning how you eat, live, and breathe markets, and it's very obvious when you read your stuff that you are passionate about it.
Thank you. But after doing this for so long, when an economic data point comes out, you know exactly what to look for.
Right. Well, you do. Not all of us. You do, and you do a great job at explaining and stuff like that. And so for people that are interested, you do have a 7-day trial there, so they can go to Peter Boockvar. And the thing about Peter's name is that there's an extra C in there. So it's Peter, and it's BOOCKVAR.substack.com. You can go there and get a 7-day trial and check it out and see all of his great missives.
Yes, they can test it out, and if they enjoy it, they can subscribe. And
great.
If not, thanks for trying.
Well, Peter, thank you very much for your time. It's a real pleasure getting to know you, and we really appreciate it.
Thanks, Kevin. I really appreciate being on, and I enjoyed the conversation.
Take care. All right, Patrick, it's time for Talking Charts. It's been a couple weeks since, actually almost a month since we've done this together.
It's been a month. Well, because it was me and Cuppy that were doing the last three. So we were talking about retail sales, whether it was risk on for assets, and yes. Yes. That's a definitive yes. And then the other thing we were talking about was the inflation numbers, and boy, was that a number one. It's amazing just the reaction the market had. Like, I don't think it was the numbers were just a trigger point, like a little spark that lit tinder that was ready to be lit with everyone being on side.
I completely agree. If you actually look at the numbers, they weren't dramatically different, but it was just the final point where people had to kind of, everyone that was in the camp of the Fed's going to tighten, they're hawkish. It was kind of the final nail in the coffin where they finally said, okay, maybe they're not going to be hawkish. And maybe
I want to talk about that chart in a second, just what was going on here. But okay, so the top three things to watch for the upcoming weeks. We have the global service and manufacturing PMIs out there. And, it's just curious whether or not the economy continues to slow from these tight credit conditions. And it'll be interesting to see what's there. But number two is the core PCE index, getting another inflation number out there to see whether or not this is a new trend will be interesting. Is there something you're looking for?
Well, I actually think your number three, the global services and manufacturing PMI, is more important than the core PCE index. Because although the Fed does use the core PCE, let's face it, we kind of know the direction of inflation. We know where it's headed. But the PMIs are much more kind of high frequency. Yeah. We can see the action and see the economy's doing it in real time much more with that.
Yeah. And so number one thing to watch is this a new bull market? Well, I have an opinion on this, but, like when the NASDAQ goes and hammers straight into its previous high, like that's a question that has to be asked, right? Like, I guess let's just transition to the charts and actually talk about them and see what's happening here. So I'm going to start here with the S&P 500. The last 3 days has been really sort of the OpEx gamma pinning that kind of just made the market trade very much in line along that 4,500 strike level. But it was the NASDAQ that I was just mentioning that went for a direct retest of that July high. And, for me, if this was just a bear market rally, and then it's supposed to be violent in one direction, but it's not supposed to be making higher highs. This is the part that, which one is it? And what comes to mind here, Kev, is sort of going back to something we talked about on the show 6 months ago, even 3 months ago. We kept talking about the analog of how things played out in 2004 through to the 2008 bear market. And what was interesting and what we continue to always have to reference is that Alan Greenspan and then later Ben Bernanke were raising interest rates 4+% from mid-2004 into the summer of 2006.
Right.
And conditions were tight. Credit markets, mortgage markets were getting squeezed on all fronts. And the stock market still managed to make higher highs in the coming year before the real top came in. And so it's one of those scenarios that just because we know tight credit conditions inevitably lead to bear markets and recessions doesn't mean we're right about it happening right now.
So does that mean you think we could get a push to new highs for the next 3 to 6 months?
It makes me sick to my stomach thinking about it because I'm on the wrong side of this fucking trade.
You have to say it out loud is actually kind of fun.
But, look, it comes down to the fact that if the market was going to be bearish, it shouldn't have been squeezed but it's the nature of the way these markets are. I think you just wrote a piece that I didn't read. It just popped into my inbox where you were talking about that we're all options traders. I'd love you to give me a gist of what you wrote about, but but to me, it's like whether it's dealer positioning, Vanna flows, whether it's CTAs and the size of their positions and whether they have to be flipped, or all of these things drive immediate market flows that override any fundamental values. And clearly everyone was way too bearish and everyone just got squeezed to death. With one of the most pronounced short-term short squeezes that we've ever seen.
Yeah, it was unbelievable. It's been straight up for 2-3 weeks.
Yeah, and 10%, right? Just a 10% rip to the upside, and I think it was there was some sort of headline I saw about the single largest 1 week flip of CTAs.
Yeah, I don't know if I buy all that CTA stuff. I see the,
you know what,
the announcement.
It's above every single moving average. I don't know what metrics different CTAs use different ways of determining that. But there's no way you can stay short based on a CTA.
Oh yeah,
signal.
no, I'm not disagreeing with you there. And actually, I still love Andrew Beer's ETF, the DBMF, because instead of kind of dreaming up what potentially CTAs might be doing based upon their rules, they're actually backing out the returns and figuring out what the positions actually look like. And when you look at that, it's not quite as dramatic as what you see with a lot of the kind of sell side research that seems to be more geared towards giving guys something to talk about as opposed to actually giving you some insights. Like I'm just pulling it up right now. They're actually a long. So like it's already flipped. Like according to DBMF, which is reverse engineering this the CTA's positions, they're showing long 2.55% of S&Ps.
Yeah, but they should be long at this moment.
Right. And I agree, but I'm just
but the point is that when the market broke to a lower low in the mid October, I don't know how any CTA could be at least very few CTAs, only ones that have very lax rules could have possibly stayed on the long side because there's very little discretion with CTAs. They're trend following.
Yeah, no, you're absolutely right. They were short, but they've already flipped is my point. And I just, but I guess what I'm saying is that I see all this stuff about, if it goes up this much more, we're going to get all this buying. And it always sounds so dramatic, and I really don't think it's as dramatic as they think. Like it's already happened.
It's happened. I agree with you actually, because think of it this way: any vol targeting funds, the VIXs and all vol metrics are right back down to the summer lows. You have all the CTA buying have already happened, and all the Vanna tailwinds are mostly all realized. And so you have a scenario where, well, what is the next incremental flow driver that is going to cause a material advance in these markets? And I don't know what that is. And maybe that in itself is the puzzle piece to solve. But obviously, there's lots of reasons why the stock market is going to find resistance along its previous highs. But, if the market doesn't do anything bearish, I mean, maybe what we're destined for is really a market that is in a tight, low-vol trade range into the holiday season, where it has no reason to go down, but no real buyers to drive it next level higher. And really, we end up having just much more boring, low-volume, tight ranges that may be like the definition of the holiday season.
Yeah, that's actually probably a very likely scenario. We're still going to get listen, we've gone a long way. We're due for a pullback.
Oh, of course.
Yeah.
Like any fib retracement.
Oh, here we go.
But,
Fibs.
at this moment, though, I would be hard-pressed to say it's going to be much more than the S&P dropping to 4,400. Like, I mean, yeah, there's a very important level down to 4,300, but I don't think it has to be a 200-point pullback.
Yeah, no, I agree.
And so like 120 S&P points throw back just to kind of find a place to settle in, especially in the post-OPEX where all the pinning is gone, overbought market. It could easily revert back. Now, I wanted to highlight a couple of things. So NASDAQ obviously already directly tested its summer high, which is pretty impressive, as I felt that, at least I was fishing to see whether or not there would be some sort of sector rotation where, some of the unloved stocks would, end up taking some of the new flows, and we see a little bit of rotation out of the Mag 7, but there's no sign of that whatsoever. Like the Mag 7 continued to rock and roll like it's 1999 again.
I tend to agree. I did a study, and I was hopeful that it was going to be at the end of October, we were going to have a rolling over of the Mag 7, and every piece of me wanted it to be like, oh, this is it. It's going to roll over. And what I found was when you had this sort of outperformance of kind of equal weight versus the market cap weight, or whether you had one group that was doing well, it just seemed to keep going right into year end. And there was no signs. And the only thing I did notice is that obviously the small caps get a good bid into into the end of the year. The Santa Claus rally, like Santa loves small caps. He really does. And I know it looks like shit, and it feels terrible, and I'm not trying to say you buy it now.
But even then, look, it burst higher. Yep. Okay, so it's trough to peak was a 12% move, but it barely retraced half of the major decline. So it did move. But if you, let's say, look at the, Russell over the NASDAQ, as just looking at the ratio, it's still I'm not saying it's time yet.
I'm just saying that's going to be the final, like that's mid-December you start looking at small caps. Maybe even early December. A couple of weeks from now. That's when you start buying them. I'm not trying to say you should go buy them now.
It's okay. I believe that the Russell will participate. If the market holds up, the Russell will hold up. I don't think that there's going to diverge, but I don't know if you're finding alpha by being in the small caps. At best, I think you'll be a scratch trade and going one against the other.
Well, I like your pessimism about my trade.
It's not about pessimism. I just think that it's too much work for doing nothing. Like, just go long. I think if you go long any of the indices, you're going to get the same result.
Okay, I disagree. I think the last 2 weeks of the year will be best. The best part of.
Okay, but that's a very small trade.
Yeah, no. That's what I'm saying. I'm trying to save you. The juice at the end of the year is going to be small caps. They're going to be down and out, beaten up. I'm hoping that they go even lower in the meantime. We get maybe everyone pushing up the Mag 7, and these things just keep languishing, and then it just in a whoosh in the last two. Those 2 weeks around Christmas and New Year's when there's just nothing going on, and it just gaps higher and there's just no offerings.
Yeah.
Anyways, what else you got?
Oh, good luck. Good luck, kid.
Yeah.
All right. So the dollar
Thanks,
index.
Dad.
The dollar index. It took an ugly hit on that CPI number.
Were you surprised by that? Because I think a lot of people were.
I felt that the dollar was going to pull back towards 104. I just didn't think it would do it in one day.
Right.
And with this, I think that in a general risk-on period, the dollar tends to be consolidating in that period. It doesn't have to be outright bearish, but it doesn't. Rarely do you have risk on when the dollar is making big advances upside with momentum, right? So I think the dollar is going to stay in consolidation for much of the next year, the remainder of the year, like in the next final 6 weeks or so. Maybe we get down as low as 103 or something, and then it trade ranges and bounces around a bit. But I think that the next kind of risk-off period is once the dollar's done this consolidation and starts to show bullish signs, then that could be one of the canary in the coal mines that you could watch for when maybe it's time to start lightening up on a couple of things. Right now, it's the thing of it pulled back 3 points, and maybe it's got another point to the downside, is my opinion. So the most of the damage on the dollar is done. I just don't see a scenario where like the euro's going north of 110 or something. This kind of bounce in my mind has already happened. But what is interesting is the way that the U.S. dollar yen's been trading, because that 102 is now truly 152, is developing substantial overhead resistance. And the bigger question is, will we see that U.S. dollar finally start correcting against the yen, finally allowing you to have some breathing room on that horrible trade you've been in?
Like the MOF, which is Ministry of Finance in Japan, they're like your parents when you're driving, and it's like, don't make me pull over and pull this car over. Because that's what it is. They keep threatening everyone. Don't send it higher. Don't send it higher. Don't you make me have to intervene.
And over the next little bit, a U.S. dollar that pulls back to like against the yen that pulls back to 148 or 146 wouldn't surprise me after such a prolonged period of U.S. dollar strength, and that could be what keeps the U.S. dollar pinned for the rest of the year. As maybe the euro's a little overbought on the short term, but if the euro is chopping around, but the U.S. dollar's pulling back against the yen, then the Dixie stays, pinned to the bottom end of that range. I think bottom line is the rest of the year is going to be a big currency muddle. I don't see a major move this year. I think there's big currency moves next year coming, but I think most of the excitement is over now.
You heard it here, folks. Patrick's basically just guaranteeing we're going to get a lot of FX excitement last month. Strap in, folks.
But let's talk about gold.
Oh.
Like what an interesting little. Well, I mean, obviously, now that they've pulled all of the probabilities of the Fed doing another hike out of the market, gold loves easing. So as it's clear that we probably have seen peak Fed funds rates, and inevitably a year from now or whatever, there'll be some period where they'll start easing. I think gold took it well last week, but the interesting thing for me will be, will we get above 2,000 in the coming week? Obviously, we twice, once in the July and again here in October, tried to clear 2,000 and got rejected each time. Be interesting to see whether this kind of an upturn allows gold to make a shot at its second quarter highs up near 2,075. It's certainly a little bit of momentum, but until we've cleared 2,000, I'm not 100% all in on this being a breakout that will sustain. But what's interesting was that the one that did really confirm that was silver, because silver did a clean retracement, and then, where do I have it here? And just blasted itself to beat the October high. And so it looks like these precious metals are getting some attention here.
What do you think about the miners?
they're getting no love.
Getting no love.
They're getting no love. They're underperforming bullion, which is a rare thing because usually you pick up alpha by going into the equities over the bullion, but bullion's the one that's been moving, and the miners can't seem to get off the mat.
It's pretty ugly. Our buddy Ron Sterfoli from Incrementum, he emailed me the other day when we were chatting, and he said he was at a conference in Switzerland, and the amount of pessimism out there for the miners is off the charts. Nobody cares. Like it's just, you know, I think we're getting close. It's just the apathy there, and the fact that nobody what he says.
What's bizarre to me that is we are literally like 5% away from gold making an all-time new high.
Yeah, oh for sure. They've been terrible stocks,
and the gold miners have been left for dead at the bottom end of their ranges. Yeah. At some point, though, it's an incredibly small market. There isn't much market cap in the miners combined. And so if at some point gold takes off and people want to get exposure there could be, we called it an explosive short squeeze on the S&P, but what kind of an explosive move could there be if suddenly everyone realizes they needed to have some skin in the game on this and they all try to buy?
Well, but that's been the argument for a long time.
But the point is that gold hasn't made an all-time new high. I'm saying if gold blasts off and clears its all-time high, and everyone realizes that the bus has left the station, then they're going to want skin in the game then. They're not going to do it now.
Yeah, listen, I don't disagree. I'm just saying in the next couple of months, I think it's somewhere to look at. I think it's interesting.
It's interesting, and what will be even more technically interesting is if it doesn't make a lower low. Like the fact that some people will try to do some technical, inverted head and shoulders pattern on the bottoming of this, but it really comes down to when will this. Let's just call this a big trade range down here. Turtle head poked to a lower low temporarily, but when will it clear $30? When will we start seeing a pattern of higher highs and higher lows, and that money is flowing in there? At some point, these miners will start looking like the uranium stocks, but right now there is zero sign that has begun. But I think if gold stays above 2,000 on a sustained basis, then I would move that forward and say that we should be looking much closer at it now as opposed to waiting. I think watching that 2,000 level is a psychological level that I think will get a lot of people paying attention.
Okay. You talked about uranium. Do you want to pull those charts up?
I will in a second, but I want to talk about the chart that's had my face ripped off of crude oil. Boy, that's been a tough one, eh?
I haven't been trading it, so I've been good.
I was bottom fishing. It's shameful, buddy. I've been taken through the meat grinder here.
It's because you listen to too much doom kind of podcasts,
Doom?
and they're always like talking about World War III and stuff like that.
I wasn't buying them based on doom. I took a very aggressive trade that I shouldn't have, and I should have waited for the trend to be my friend, and it didn't, and now I paid the price.
Yeah,
that's. But you know what? Like big reversal today, but it obviously came after what was nothing short of a massive bloodbath selling that happened on Thursday. But the thing that I'm going to be watching is whether they can get it north of 80. Right now, if this thing just gets up here into these mid 70s and rolls over again, then who knows? We could be testing the summer lows. As ridiculous of a thought that I think that it is, there's no reason at this moment to say anything but that the trend is down, and every rally has been hammered every time they've tried. Like, there's no sign of a bottoming formation.
You know what I was looking at? I was looking at gasoline, and I was kind of surprised at how.
This is the Jan contract, but like still ugly.
Yeah. Although it's great
and not
for
only
the consumer.
That, how about fucking nat gas?
Oh, that is yeah. The moment of silence.
This is the Jan contract. Like this was the last thing I thought I was going to see. Now, luckily, I have only a couple of nat gas equities and not any contracts on this. But the Widowmaker has come back.
Oh yeah. It's just, listen, Nat Gas is the scariest contractor in the world to trade. Just ask optionsellers.com.
It's bad. Like, look, so this is the UNL, which is the 12-month strip on Nat Gas, just hammered to a lower low. Like, there's no forgiveness. Not even the term structure is helping you out in any way.
I saw something the other day about the amount of supply that's being brought online in the U.S. And someone was like, "You'd think these guys would learn, and they never learn." And it was just basically they're continuing to drill.
Yeah,
and
unbelievable.
Well,
all right, let's talk about something that is working.
Okay,
which is the U308 is at 77.35, and that Sprott physical uranium's north of 26.
Unbelievable trade. Hats off to
fire.
all the uranium bulls and our friend Cuppy.
Yeah.
Well done.
Well, I've got skin in the game
you got
too,
some
but
too?
But I mean, obviously, he's the outspoken one, right?
Yeah, listen. I remember there was points when there was like it wasn't trading that well. It was looking ugly, and I remember talking to him, and he's like, "Nope, not even looking at it. Don't look at the quote. I'm in for the big long move." And I think he still he's. I shouldn't speak for him, but I don't think that he's changing his tune.
Well, you know what? This is one of those trades that, it's that kind of a market where when it goes, it could go. Who knows? It's I wish that the Sprott physical had options on it, because I always like convexity and shit like this. It's so hard for me because it's like I'm playing this Delta One bullshit that I don't typically do.
Although I must say I'm a little nervous because there was somebody that was putting the uranium eyes. And not only that, the Sprott
isn't it uranized? Isn't it like two fountains?
And I see the Sprott the NAV to, or the premium or the discounted NAV is actually now at a premium, and in the past that has not been a good time to buy it. So although I understand the bull,
but you know what? No, but I don't buy that when you say that at all, because the thing is that when you take a large enough data point, you're sampling the fucking decade of sideways trade range price action. But when something starts trending, all of that 10 years of sideways price action is useless information.
Yeah, you could very well be right. Not only that, it's going to go to a premium, and it's going to cause them to buy more, and it's just going to continue and continue and continue.
Well, it could be a feedback loop,
could be
right?
A feedback loop.
It's
when George Soros says, "When I see a bubble, I buy it."
Ooh, oh, so now George Soros is telling me to buy some more. All right, this is making up for the damage I'm taking on oil.
Okay.
So. So that uranium's been on fire. Let's though talk about bonds. Like obviously the light inflation number allowed bonds to pop higher. This is a 10-year note. Yields are under 4.5. So Kev, I know you might be lightening up on your trade, but that's because you're virtually a day trader. I don't even want to call you a position trader anymore.
It's just that, for me, I always said like there's
like
for me
neutral
to be
is
long,
your
neutral is like me being long, and when I was actually long bonds, like that's unheard of. Like
it's a rare event. It's
have you ever known me to be long bonds?
Cats and dogs living together,
exactly.
just like crazy ass shit.
Yeah. It was
and so you lightening up on it is actually one of the reasons why I'm considering buying some more.
Well,
it's
listen, I'm not. I'm still long, so you should wait till.
But just tell me when you flatten your position.
Okay.
I would appreciate this.
I'm still long. But I tell you,
just let me know when you flatten.
When the people that were telling me about term premium and giving me lectures about term premium and about supply. And these are folks that previously had been lecturing me about the recession, bro. And, had told me that there is no way you shouldn't not be long bonds kind of at 3 and 3.5. And now all of a sudden we're telling me at 5 that you had to be short bonds because it was going to cause this collapse. I was like, oh no, this is it. This is time to go the other way. And to me, I feel like bonds are kind of fairly priced. Like as we kind of rally here, They're just fairly priced. And they're going to be neither exciting nor disappointing.
Unfortunately, I was telling my members the exact same thing, which is I'm neither as bullish as the Bulls nor as bearish as the Bears. To me, I think that, that they've already priced in so much carnage that it wouldn't be a shocker for me if they just grinded.
Oh, yeah, I agree. That's why, we had Harley Bassman on the show, and he was talking about that MTBA, which is mortgage to be announced, which if you ever have trouble like I did with the symbol, you can remember that, MTBA. And in essence, that's kind of like owning a bond with short vol. And I actually think that it's the more I think about it, the more I'm kind of warming up to the idea that this is something that you should look at. And I see Bo's Wine. How do I say his last name? Saba Capital. He also, sent a tweet out the other day where he said that he's also got a huge position on.
Oh.
So, anyways, I think it's something to look at. Like I feel like it's the vol. Like, can you pull up the move? Like, to me, the move.
Yeah. No, I don't actually have the move.
Oh,
on
okay.
this.
Well, the volatility on the actual fixed income market is through the roof. And to your point about you said it was going to settle down. I'm neither bullish nor bearish. Kind of, I feel like that's
sure. You could short gamma.
Yeah, and I think you can do that by buying the mortgage backs, which is in essence what's happening. So, anyways, I think it's an interesting trade. Go listen to Harley's terrific guy, great great products, great podcasts. Our Market Auto Plus.
Yeah, absolutely. Go back and listen to it. The one thing that I'm curious about is if, for whatever reason, that's a speculation, we don't want to say that we know, but if the lows of bonds are in, which is the highs of yields, at least for an interim period, because obviously inflation can rear its head in the years to come, and by 2026 we can have yields busting new highs. But let's talk about it just from an interim period. If the lows of bonds and the peaks of interest rates are there, I think that they were truly the reason why all the bond proxy sectors of utils and so many of the telecoms and healthcare names with their safe dividends were forcibly had to reprice for the yields. And the question is that to the point of that Mag 7 is likely to work for the rest of the year, wouldn't it be an interesting thing if there was that transition moment where they rotated back into the more defensive names?
So I think it is going to happen. I think that you're spot on. And I think everyone's going to assume it's going to happen in the first of the next year.
Quarter.
So you have to be earlier than that. So that's why I got to go mid-December. And I think it's going to be the same trade with the small caps.
As the small I like everything you said other than the small cap part, but
fine.
Maybe that's that you should double down on your small cap trade because of that.
No, but I definitely I'm thinking the same way. And the other thing that I think folks too often forget is that the liquidity on those big caps on the Mag 7 is huge. And when they go to sell them, they're going to be able to sell them. And then when they go to put it to work in the other sectors, there's not the same liquidity. Yeah. You're going to find that it's going to push those up way quicker than people expect.
I wanted to just show this chart off of stockcharts.com, which is the percentage of stocks on the New York Stock Exchange trading above their 50-day moving average. And it's a great oscillator of overbought and oversold conditions in the market, particularly by breadth. And we got down to 15% during that sell-off, which was oversold enough to be pretty much near the levels every low in 2022 was established. And based upon that metric, it was like the market was overdue for a run. We are already now at 2/3 of stocks, 65%, 66%, now back above their 50 days. But it's not at levels the market has peaked in the past. And maybe this is a clear indication of that there's still room to go on the broadening of the market, which is more of those stocks that you're talking about getting some love. getting and their trends shift up back above their 50 days to where this kind of makes it back up to the kind of overbought conditions that are usually associated with market tops, or at least a swing high of a market. And so right now we're about 2/3 in. Let's see whether this makes it up to 80+%.
This is the most bullish I've ever heard you be. Like
I'm not bullish.
No, but kind of reading between the lines. Like you're definitely not
bearish.
bearish.
Let's just say I don't think it's going to be an easy go for the next month or two for bears.
Yeah,
that's
probably as bullish as you get. No, that's not true. You got pretty bullish at the March 2020 lows. You got full on bullish there. That was like me buying bonds. Like, but this is pretty bullish.
I just don't know what the market. My only thing is where's the next incremental buyer? So we know that where a lot of the flows that drove the short squeeze came from, but with vol already as low as it is, and all of those systematic buying mostly done, you basically need in an incredibly tight financial condition where accessing credit is not easy and it is relatively expensive, where the additional flow comes in to drive a new trend in the market. And to me, what would make me get bearish again would be a market that just can't find any new buyers, where it's like it rallies, meets some selling, rallies, meets some selling, just can't get any traction. If we're grinding it all through the entire holiday season, that would be enough to get me bearish for the new year.
Okay. There you go.
But right now I don't see that. All right. That's all I got, Kev. I think we should go on. But do you have some chart that you wanted to look at?
Oh, you know what? Actually, I don't.
You did.
I completely forgot. Okay. You know what? I promised next week to have,
next week
to have crayons with Kev.
Oh, okay. All right. So let's go on to new stupid question. No, not new stupid questions.
They're also new.
They're new.
Hey, Lena.
So I'm implying that these are no stupid questions, only stupid really answers.
I know it's got it. I really screwed up when I bought that one.
Lena, save the day.
Okay, let's go.
Okay. Hi, Kevin and Patrick. I'm a longtime loyal listener here from Taiwan. Thank you guys for the great content and updates. Market Huddle is one of my must-listen podcasts every weekend.
They must not get all the podcasts there in Taiwan. How did we get through, by the way? Anyways, go on.
My question is, what other factors drive bond yields at the short end, 2-year, for example, besides Fed funds rate? Are there other considerations I need to think about when it comes to going long or short-term bonds? Is short-term bonds the best hedge besides buying puts if one is pessimistic about the economy and market in general? Thank you guys so much for your time and patience.
That's a great question. You want to start, Patrick, or should I go ahead?
I'm gonna just pitch you a ball to hit. Overall, because of its shorter duration, it does have a very large influence by the Fed funds rate, and more importantly, the future path of Fed funds in that. But in terms of nuances, I'm not actually sure. Feel free to elaborate.
It's almost all Fed funds in terms of when you're thinking about the shorter end of the curve. Like, just take, for example, like a 3-month bill. It's based upon the Fed funds. And when you're talking about the difference between like Fed funds and a 3-month bill, those changes, it'll be like minute. And so, people that are in the know and trading plumbing might be talking about that spread's going to go from +5 to +10, meaning 5 basis points or 10 basis points more. But for the rest of us, like mortals, it doesn't matter. It's all Fed funds expectations. Okay. And obviously 2 years, it's a little bit, it gets more as like, a 1 year, T-bill would be different than a 2-year in terms of there's a little bit more risk. So there is still what they call a term premium in terms of what extra you have to get in terms of the expected Fed funds rate over that 2 years. You could ask for more, but it'll be very minor. But one of the things I did want to kind of highlight is short-term bonds the best hedge? And They're actually not bonds because bonds are longer than 10 years. But so it's
yeah.
short-term notes. And the best hedge besides buying puts if one is pessimistic about the economy and the market in general. Traditionally, this has been the go-to trade. And if you go think about
ask Stanley Druckenmiller.
Yeah, Stanley Druckenmiller's got a whole bunch of twos. You go through time and time again. Like I remember Raoul Paul from Real Vision talking about one of his traders that he worked with somewhere. He just bought a whole bunch of Eurodollars and levered them up and made himself a fortune with some obscene amount of money. We go back to our friend of the show, Morris Sachs. He talks about how he was on the other side of Paul Tudor Jones' 1987 trade, where he bought 5-year notes along with being short the stock market. He bought 5-year notes. I've even heard that a lot of times when you go look at the P&L attribution for a lot of these big hedge funds, those kind of Soros, Druckenmiller, Tudor Jones, they actually make more money on the fixed income portion of their trade.
Well, absolutely. You can 100 to 1 leverage on it because of the low vol, and you can while it only moves like 3 percentage points in terms of the bond's change in price, when you've got a 10x leveraged, it actually makes a real return.
Right. So and I think I touched upon this when I was talking with Harley. If you go look at the past couple of cycles, when they've cut a lot, meaning that even 2000, it was like 400 basis points within a year. 2008, it was 500 or something.
How do you?
Sorry, go ahead.
I was going to ask you, how do you manage the trade? Because obviously the liquidity is always 1 quarter out, like 3 months out on that, and like they could give you 6 months out. But is it just as simple as rolling it every 3 months?
Well, that's one way to do it. Some people times they could just go and bet on, like they could buy a strip of Eurodollars in the old days, and now
okay, yeah. So you're saying go into the SOFR futures now,
and they can go do that. So you can actually bet on those things.
But it's like SOFR futures, let's say you go out to 2025, they're only yielding you a 4%.
Right. And so now this is
like
what's different now is that a lot of times when those hedgies in the past were putting on those trades, they were actually carrying in a positive way because the curve was normal. It was upward sloping. And so now as we've gone through time and people are aware of this, we've got more people that are trying to game this. And I would argue that, in fact, this is part of the reason that the curve was so inverted was because everyone was expecting a recession, was expecting a market collapse, and was piling into those trades too much. The recession bro trades, like they all were like recession. I do find it ironic that everyone seems to be giving up on recession when it's more likely than it's ever been in terms of like you see,
absolutely.
Like it wasn't a year ago, wasn't time to be, sure a recession's coming, but it's sure looking a lot more probable today. Anyways, it is a difficult game that you in terms of the front end of the yield curve, but it is something that has traditionally made people lots of money. But and I just want to do a big but. We haven't had a situation with this much inflation. We haven't had a Fed chair that's been so much wanting to evoke the Paul Volcker, and maybe the fact that everyone is expecting that trade to do well, maybe it doesn't. And just keep your eyes open because it's always slightly different. And I'm worried that this one might be slightly different. Anyways, next question.
Next question. Dear friends, I piggyback on many of the ideas that your guests discuss. Of course, they always say DDDD or do your own damn due diligence. My quadruple D is to look at a chart of the investment, read any news I can on it, go on X to see what others think, and to investigate the guests to learn about their performance and trading style. So far, this has worked out wonderfully for me. Since I am a non-professional without a staff or vast reams of data or even the intelligence to interpret the data, what else can I do? If you had my limited resources, what more would you do? Love your show and your guests, and especially the Coloring with Patrick segments.
Oh, Patrick chose that one.
Well, Kev, I'll take a first stab at it, and then you can add to it. To me, I kind of ask myself always, if I went and I tore apart the company's balance sheets and sat in on more meetings and things like that to learn more about the company, can I in any way attain a further alpha in having done that? Or or can I attain more alpha through the proper risk management of my trade sizing and the management of the trade? And so I often will allow the analysts that do most of the fundamental work. I kind of say that ultimately, I don't know if I could do it better than they do. So I often will lean on their fundamental work, and then I try to gain my edge through the active tactical trading around that position is the way I approach it. What do you think of that?
I actually think that's a brilliant answer, Patrick. And what I was going to take was slightly different, but it's along the same vein, is that I was saying that the people all think that they're trying to beat the market. And there reaches a point where you get good enough and you start to figure out the markets, and then you realize that you're actually trying to beat yourself, meaning that you are your own worst enemy. And as you become more knowledgeable about the markets, it's time to actually expand and to go work on the psychology behind, trading and what you're doing and what you've and how you're dealing with all these different parts. So I'm in the same vein, like the same kind of thought process as you, is that keep working on all the kind of external things, but then start looking at the internal things a little more. So go read some psychology trading books. There's a whole bunch of them. And all you have to do is go look at Steve Cohen at SAC, one of the greatest traders out there. They had a full-time psychologist on staff. Yeah. And so I think you're going to find that it's actually yourself that you should be worried about the most. And as an individual trader, I think that one of the things that's most difficult is that there's no one holding you accountable. So you have to find ways to hold yourself accountable. And so what I would suggest as well is...
No, it is you just have to bring your wife to the office.
That's right. But or you can go and do journaling. Make sure you write it all down. Log it. And be really honest about when you make a mistake and do those kind of brutal things. But keep it up, because I think it's great that this listener is doing so well.
What I was going to say was I have a saying in Big Picture. I always say I like to technically trade fundamentally good things, right? You basically want to first do some due diligence to make sure you got something that's a good anchor, and then you try to technically interpret, where you are and what is the risk reward of being in the trade at any one time.
And there's a million things like that. Like Paul Tudor Jones, he's got this simple rule: he doesn't buy anything that's below the 200-day, doesn't sell anything above it. And I'm sure he breaks that rule and stuff, but on the whole, there's things like that keep these guys out of trouble. And I think you'd be surprised at if you make sure you don't get yourself into trouble. Like that's the majority of the battle. Okay. Next question.
So next question. Hi guys. Big fan, blah, blah. Oh, anyway, heard Ole talk about backwardation in commodities and ETFs.
Whoa. 1 second. Isn't that the other podcast? Did this guy need to send it to my Macro Voices and got the wrong one?
I think so.
Should
Anyway.
I continue?
Yeah.
Yes.
Okay. So how does that work in practice? Say for BNO, the roll happens. They sell higher contract, buy cheaper one. Where's the leftover cash go? They buy more contracts? Do they buy more of the fund? I'm assuming he's talking about money market fund. Is that? That's what I'm assuming. Having trouble visualizing how that roll down is reflected in the ETF price and return. Thank you. Fun fact, I worked for Paul Craig and the other guy for a few years.
Ah, that is fun. Oh, no, he got the right podcast. Yeah. That's great. The reality is that they do buy more of the underlying commodities if they can.
Yeah.
And
vice versa. If it was in contango, they would buy less.
Right. And that's just the way it is in terms of they're always trying to be fully invested in the actual the forward price of it. And when they price it out, they sell the one and buy the next, and they figure out how many contracts they can buy and do it. Now it ends up being a little difficult if you have like a group of a bunch of different commodities and you're trying to figure out the exact weighting, and let's say that the fund isn't absolutely huge, there's a certain amount of kind of just, okay, like let's round to this one, let's do this. But in practice, if the fund was enormous and you were trying to get it perfect, they would buy more when it's kind of at a discount in the future.
All right. That's it. So, Lena, where can they submit their questions for the future?
So if you have any questions that need stupid answers, please submit your questions to nostupidquestions@markethuddle.com.
See, she knew how to execute the joke. I didn't even have to write it down for her. Yeah, Kev.
That's the problem. You wrote it down for me. Okay, so let's talk about my dinner.
Well, yes.
We almost forgot.
Yes. Can't forget.
So we thanks for all the submissions,
That's right.
everyone.
Thank you so much. We
got
have more than enough. We have tons to choose from. It was hard to choose, but I went through and I found 3 that I liked, and that with some great quotes. I guess I'll just say them for now. I won't use any last names. We'll be contacting you by email. So Paul C, I really liked the fact that he was a big Vincent Deloitte fan and really liked Emily in Paris. And so I kind of felt like we had to go with anybody that's a big Emily in Paris fan. And, maybe we should see if Vincent Deloitte can join us. And then K with the last name, he had his great quote that I'm going to use, and it's actually one of my favorite all-time lines. And I didn't realize that Harley Bassman said it on our show, but it makes sense. He says, Harley Bassman says, "I've never bought the bottom except the time when I went to sell and hit the buy button by accident." It's just, it's so great. Like, that is like, that's why I love Harley, that he kind of laughs at himself. He says, the reality is that most people don't buy the bottom, and he doesn't try to be a hero. And I can't say enough about that. So, and K is coming with us. And then finally, UNC is coming. Ewan, he chose a line from Morris Sachs. He talked about cocktail party bullshit, which I think is great. And Ewan is also a business, like a university student. So I thought it'd be nice to have a younger fellow there too. And he's probably going to drink IPAs. So we'll... Someone's got to drink them. So we're going to go to a craft beer place, have some fun, talk some markets, and enjoy ourselves. And everyone
at your expense.
That's right, at my expense.
I love it.
So we can talk about what an idiot I am. How I was up, 12, 15 points or whatever, and I ended up losing.
And then you choked like the Toronto Maple
Leafs.
Leafs.
It was really pathetic. And I'm not bitter at all at the rule change.
Not at all.
Yeah.
All right. Okay. Let me grab the script about actually, I don't have the script, so we'll just go with it. Thanks for tuning in. It's always a pleasure to have you on the show. We appreciate your time. Patrick, where can they find more about you?
You can find me at bigpicturetrading.com or on Twitter at Patrick Ceresna. And Kev, where can they follow you?
They can go check me out at themacrotourist.com and listen. Bull market, bear market, it's always great to have you guys along for this crazy ride. And now stick around for the after show.
All right.
Okay, I got to give this beer.
This beer that's
it's not a beer.
You said it's not even beer.
It's not a beer. Exactly.
Whiskey soda.
We're not even allowed to rate it. We can't.
Okay, that's fair enough. Let's not rate it because it's.
It tastes like if they took soda and they put it on whiskey and they put it in the can
with a little bit of lemon.
No, actually, I didn't have a hint of lemon. They said you could add lemon.
Oh.
It was just like I opened it and I immediately just smelled it.
Smelled it.
I was like, oh god, this is
like
gonna be bad.
You have the gagging reflex because you don't drink whiskey.
Yeah, and it was kind of like it's even worse because I didn't cool it like an idiot. And so
for a whiskey soda, since I've had it like 3 times in my life, I would rate this like 7 on a whiskey soda.
Whiskey, I'm not rating it. All right,
that's fine. So listen, we have a confession to make for you.
What's that?
We reached out and tried to get Lindsay Lohan.
Oh, you did. She's busy busy having a baby.
I was about to say.
Whose baby is it?
Yeah, Kev, do you have something you want to share with us?
Lindsay's way out of my league.
Yeah. but we tried, and
honestly, you guys went and tried again.
yeah,
Yeah, she snubbed us this time around.
So this time we're going for deepfake. We're looking for her for all those statements and stuff like that from her past things, so we can build a large enough vocabulary so we can.
Oh, it's very kind of you to even think about me. But you know what?
Well, listen, happy birthday, buddy. It was.
Thank you very much.
Well, I hope you enjoyed your time off.
Time off. I did go. That was on Friday, right? And then, but I did go. I just want to let you know, I went to Depeche Mode like a true Gen Xer.
Ooh, how was that?
It was really
that is
good.
so Gen X.
I like Depeche Mode.
Yeah, I really liked it. It was good. You know what, Lena? I was surprised. There was a lot of young people there.
Depeche Mode is like the older millennials kind of got the tailwind of Depeche Mode.
For sure.
No.
And then the other thing was the
yeah.
last Depeche Mode concert I went to was 1988. And there was not a guitar in sight in 1988. Like, it was all keyboards. And I was shocked at how many songs there was like guitars. And like there was a couple that was like no keyboards. I was like, what the hell is this? Like, what's that?
No keyboard.
Yeah. And then the pisser is I was looking at the different set lists. And we got a shitty, like, you know how they have a few songs that they change every set?
Yeah.
Like, we got a shitty one. We missed the Question of Lust. We missed, I think, Somebody or something else from Black Celebration.
But they hit like Personal Jesus.
Oh yeah, they do all those. Like, they did all that.
They'll do the classic highlights or whatever.
There's but there's a few that they
whatever.
do that they choose. Anyway, it's just fun. It was a good time.
This was in Toronto?
Yeah, they came to Toronto.
Oh.
Yeah. I must say that they got...
Lena's now in Lisbon, so she's going to check the Lisbon concert schedule.
Oh, you should. They're
That's
great.
right.
They're a great show. Like, they're really good. You also, I want to see The Cure. And I've actually never saw them even in their day.
Yeah.
Patrick's like, I have nothing to contribute.
No, listen, I actually loved Cure.
Really?
No, as a teenager, I was huge into Cure.
That's actually shocking.
Tell me your age without telling me
you
your
know what?
age.
It's funny. Listen. Let's be realistic. I at one stage for a couple of years in high school, I had the mullet with the Iron Maiden and Led Zeppelin shirts on. 100%, I did that, but like a complete wannabe, I did 1 year of my high school where I flipped. And I would like tuck my jeans in. You remember when you would do the tight folds at the bottom?
We would
what is that
sew
called?
them or whatever.
Like taper,
taper them.
taper the jeans in with the Flock of Seagulls haircut.
Oh my god!
So you went from Iron Maiden to Flock of Seagulls for a year?
No, for a year, and then I realized that wasn't a good idea. Realized that I was a true wannabe.
I must find some pictures, evidence of.
Oh my God! No,
haircut.
let's not ever.
I have my sources. I will find it.
Oh yeah! Oh my God!
That is hilarious. That is. I never pictured that. I thought you'd be just like Iron Maiden the whole way through.
I had a proper mullet.
Did you also
at one
wear
stage.
like a guy liner?
What's a guy liner?
No.
It's when guys wear eyeliner.
Oh
no.
Guy liner. I've never heard that before. That's pretty funny. Although guy liner,
you know what?
The one thing, like the Cure stuff. Is that what you're saying? Like he was trying to be all new wave.
I don't know. I mean, if he's trying different things whenever he liked different music, I wonder.
Yeah,
he's gonna go ahead and get Flock of Seagulls hair.
Patrick had his experimenting stage in high school.
The one thing
we shouldn't judge it.
The one thing I have no regrets about. Was there was a phase where my two buddies got into parachute pants, and I basically said,
"You tapped out.
That's too far."
I drew a line.
That's too far.
And that would have been something that I would have to this day dreaded, but luckily I never put on a pair, and I'm proud.
I don't even remember parachute pants.
Oh yeah, absolutely. That was the MC Hammer kind of days.
Oh geez,
right?
okay, yeah, that's like, you're a little younger than me, that's why.
Yeah, that's a little later.
Oh yeah.
I mean, a little younger, like 3 years.
But that makes a difference though, because we never had that. Do you know what, Lena? This is an embarrassing. So Patrick's saying the fact that we would go and taper our jeans. So we used to go to Kensington Market and buy jeans and buy old ones and then taper them. And then the big cool thing, if you were really cool, you'd go buy Levi's 501s and you'd cut off the fly so that people could see the buttons. Kind of embarrassing.
Makes sense.
Isn't it funny what kids do? And you're like, oh, that was so cool.
Why was it cool to show off?
Because you had like the real 501s with the.
Who needs a zipper? Who needs a zipper?
No, I understand. But
like it was just cool. I don't know. Like I remember as well. Like there was.
I mean, 501s are still cool.
I know 501's unbelievable, isn't it? How like that thing's just lasted. Like that jean jacket, the 501 jean jacket is just always. Every generation, it's just figures it out.
Especially Canadians. It's the Canadian
tuxedo. The other one is the Doc Martens. I'm shocked that they're still cool. Like those were huge in my day.
Oh, they're still huge.
Yeah.
Yeah.
They've managed to stay that way.
Oh yeah, no tapered jeans with Doc Martens was that was a staple.
And then the other thing that even before that though was like in middle school we used to buy Roots sweatshirts and put them inside out in Beaver Canoe.
Wait, hold on. Why would you turn it inside out?
I don't know.
It was a thing?
Yeah. I'm sure you did some stupid stuff.
We used to get Roots sweatshirts and sweatpants and stuff.
Yeah, I know, and
woolly socks.
Oh, like definitely those brands, but I don't remember ever being turned inside out. I don't remember that part.
You weren't inside out.
Because you weren't cool.
You weren't cool.
I wasn't cool.
Lita,
too busy with my Led Zeppelin
shirts. Because you weren't cool.
I was trying to whisper.
Anyways, did anyone else do anything exciting? Lena, did you do anything you want to tell? You're in Lisbon?
I'm in Lisbon right now.
So what do you got planned?
Not much. I'm going to see Patrick in a little bit.
We're going to go drinking.
For drinks.
Boy. I sense a theme with Patrick.
A buddy, but my buddy, you know Topher, you've met him before.
John Snow.
He's flying in. John Snow, yeah. The one,
the guy.
Remember that you'll never take a photo with him beside you again?
No sense doing that. Like, you don't go and take photos right beside some good-looking guy. It's like,
absolutely.
Somewhere
and then worse, you put it on Tinder, right?
Better that than Grindr.
Why are so many girls messaging me with like, is your friend available?
Anyway, say hi to him. Say hi to Jon Snow for me. Good guy. Anyways, have a great time, guys. I'm gonna let you go. I gotta get back to trading.
Yeah. Good stuff. All right. Okay. Listen, it was a great episode. Have a great time.
And happy Thanksgiving to all of our American listeners.
Yes.
Absolutely.
Have a great time.
All right. Thanks, everyone.